So for this week's module, I chose to focus on raising capital by selling stock. I chose this topic because corporations are separate legal entities that so they themselves raise capital so that way they're not liable for any debts. So pretty much people who invest in their company are the ones that end up being liable. So they sell stock and then they sometimes also buy back their stock. And there's two different types of corporations. There's private and public, which I will talk about. So private versus public. So private corporations need to raise their initial capital. So these are probably corporations that don't have the capital themselves or the means to put in to their company. So there are angel investors, venture capital firms, institutional investors, corporate investors as well, that all can buy stock from these private companies, but those are the only types of investors that can purchase stock. Then there is going to be public corporations. So these are corporations that have made their stocks public. So other people outside of the four investors that I mentioned for the private firms, their stocks are public for other people to purchase them. And there's benefits to doing this, to going public with your stocks. So there's benefits to the firm. So, which means that they have obviously greater access to capital, so there's a greater pool of investors, so therefore that they have greater access to capital. And then there's investor benefits as far as diversifying. So now I'm going to focus on private companies and the sources of funding that they receive. So as mentioned before, there's really only four types of investors that can invest in a private company. The first one is an angel investor. So an angel investor, these are individuals who buy equity in a small private firm. So they're individuals who have the means to invest in this company, and they obviously see some sort of benefit in buying stock from them. There are venture capital firms, which are limited partnerships. They specialize in raising money and investing in these small, young private firms. Institutional investors. So these are larger organizations. They manage larger amounts of money to be able to invest in these companies. So those would be things like pension funds and insurance companies and other foundations, things like that. Then the last one is corporate investors. So this would be large corporations, obviously public corporations, that they invest back into more smaller private firms. So these would be firms like before they go public. Now when it comes to public companies, so really there are private firms that decide to go public, so they obviously see the benefit in going public and being able to search from, again, that larger pool of capital that they can receive. So initial public offering, so this is the very first time that a private company goes public with their stock. So we usually call it the IPO. And then there's seasoned equity offering, which is when the stock returns back to the market for people to be able to invest back into. So that would be something like an investor in one of the private firms, then exiting the market and selling their share. So that's a seasoned equity offering. So now we're going to focus more in on the IPO process, or the initial public offering process. So what does that look like? So what that would look like if a private firm does decide to go public, One of the first steps that they are going to take is that they are going to want to find an underwriter. So the underwriter is going to be a investment banking firm that is going to be able to manage the issuance of their new stock that they've created by going public. They're going to also want to file a prospectus with the Securities of Exchange Commission, or the SEC. So the reason that they are going to want to do this is really just mainly like a part of the registration process of going public. What this prospectus is it does contain details of like the new stock offerings, how many shares that the company is going to have, what the price is for those shares, and so forth. There is also a process as far as like that is kind of, I guess, like the draft of them going public. They obviously can, so the senior management of the firm would then try to go out and sell these different stocks or kind of advertise them, and then from there they can also come back. They would be able to decide like on a final price. They can like tweak I guess the pricing and the number of shares that were put into the prospectus in order to get to a final concluded price. From there then, once they have everything finalized, they'll be able to distribute the IPO shares onto the market. The last thing that I chose here for ethics, I just focused on probably like bad business deals. So, and I'm more or less talking about when when an investor, like in a private firm, decides to sell their share and move on or whatever it is, so they decide to put their share back on the market. So just bad business deals kind of between both the private firm and the investor, and I think that can kind of go either way when pulling one over on the other. So the Bible verse that I looked at was, "The acquisition of treasures by a lying tongue is a fleeting vapor, the pursuit of death." So really this just again kind of says that if you are going to try and lie and